You ever watch a trader just absolutely nail the perfect entry while you're still sitting there staring at your screen wondering what just happened? Man, if you've ever felt that sheer frustration of getting stopped out right before the market completely takes off in the exact direction you predicted, well, you are definitely not alone. It kind of feels like the institutional players have a crystal ball, doesn't it? But honestly, they don't have magic. They just play by a totally different set of rules. Welcome to this explainer, where we're going to crack the code on exactly what those rules are. Today, we're shifting gears from the macro view all the way down to the micro. We're going to demystify how smart money, those massive institutional players, actually moves the markets. By the end of this explainer, your whole view of the charts is going to change. You'll stop seeing just arbitrary moving lines and start seeing a literal collision of supply and demand. We're learning how to track the giants. Here's our roadmap for today. We're kicking off with Inside the Order Book, then finding the footprints of smart money, comparing an order block to a fair value gap, diving into the wick rejection setup, looking at when order blocks break, and wrapping it all up with the institutional trading playbook. All right, part 1, Inside the Order Book. Let's get right into it.
To really understand smart money concepts, we've got to start at the foundation, the actual engine behind every single tick on your screen. And that means defining liquidity. Liquidity is basically just the market's capacity to absorb buying and selling pressure without going crazy and causing massive price swings. It's represented by resting limit orders, bids from buyers and asks from sellers, just waiting in the order book. Think of it like the market's shock absorbers.
And the difference between deep and shallow markets perfectly shows why liquidity is just absolutely crucial. If a huge institution wants to buy, say, tens of millions of dollars of an asset, they literally can't just smash the market buy button in a shallow market. If they did, they'd chew through all the available sellers in a split second, cause a violent price spike, and give themselves terrible execution prices. No way. They need deep markets to absorb their massive size quietly, with barely any slippage. So, moving on to Section 2, Footprints of Smart Money. Because institutions have to quietly absorb all this liquidity over time, they can't help but leave behind evidence on the chart. They leave heavy footprints. Check out this quote from volume spread analysis expert Tom Williams. Professionals always buy during downtrends and sell during uptrends. Now, to a retail trader, that sounds totally backwards, right? But from their perspective, it makes perfect sense. They actually use the downward panic and momentum of retail traders as a liquidity launching pad to fill their huge buy orders. So what does this actually look like on your screen? Enter the order block. An order block is a specific price zone where major institutional order absorption happened right before a huge explosive move in the opposite direction. It marks the exact tangible zone where smart money absorbed all those retail orders. It's literally their footprint. Now, here is where it gets a little counterintuitive. A bullish order block, which is the launch pad for a massive upward rally, is actually a bearish red candle. It's the seller's last stand before buyers just absolutely took forceful control. And conversely, a bearish order block is the last green bullish candle before a huge drop. When price comes back to these specific candles later on, they usually act as super strong support or resistance because those institutional orders are still sitting there defending the zone.
Okay, Section 3, Order Block versus Fair Value.
As we dig deeper, we absolutely have to clear something up because people mix these two concepts up all the time. A fair value gap represents an extreme price imbalance. It's that visual gap between candle bodies where price just jumped so fast it left empty space. But an order block is a physical zone, the actual candle body or wick where heavy orders were absorbed right before that explosive jump happened. So the fair value gap is the empty space of the jump, while the order block is the firm ground of the launch pad itself. Make sense?
All right, moving into Section 4, the wick rejection setup.
Let's get tactical here and zoom in on a really specific, actionable setup within the order block family called the ICT rejection block. Now, unlike a regular order block that looks at the main body of the candle, a rejection block focuses entirely on a long wick. Specifically, a wick that jabbed past an old high or low, completely swept up retail stop losses in a liquidity raid, and then violently snapped back. That unfilled portion of the wick, that becomes your precision entry zone. Okay, so how do we actually trade this thing? Here is this simple 6-step playbook for a bullish rejection block. Step 1, set your daily bias. Seriously, never trade against the macro trend. Step 2, find a swing low that just got swept by a long wick. Step 3, highlight that exact wick zone. Step 4, and this is where people mess up, wait patiently for the price to retrace back into that wick later. Don't chase it. Step 5, drop to a lower time frame like a 5-minute chart and look for a market structure shift to prove the big players are actually stepping in. Finally, execute and put your stop loss safely below the extreme tip of that wick.
Which brings us to Section 5, when order blocks break.
Listen closely to this part because these zones are not magic impenetrable walls. Knowing when an order block fails is honestly just as important as finding one. We call this invalidation. If a full candle body closes completely beyond the boundaries of your order block, like say below the lowest point of a bullish block, that's a huge red flag. It signals a dangerous shift in order flow. It means the institutions are packing up and no longer defending the level. The setup is dead. Don't sit around hoping, just get out. But here's the really cool part. When an order block fails and breaks, it actually recycles into what we call a breaker block. It's exactly like old support turning into new resistance. A failed bullish order block flips into a bearish breaker block. It transforms from an accumulation zone into a trend confirmation zone. The market is just incredibly efficient like that.
Finally, Section 6, the institutional trading playbook. To bring all this theory into the real world, let's lay down some absolute rules of engagement so you don't fall into the usual retail traps. First, like we said, never force a trade against the daily bias. Counter-trend order blocks fail all the time. Second, do not set your stop loss too tight inside the wick. Give it a timing buffer beyond the extreme, or you're going to get tagged out for sure. Third, avoid trading in low volatility windows like the Asian session or lunch. You really want the high volume of the London or New York opens. And lastly, never force a block if it wasn't created by a massive, clear momentum move. Now, you might be wondering, does this actually work? Well, when you stick strictly to a clear daily bias and high volatility windows, the rejection block setup boasts a super solid 55 to 65% win rate. Pair that with an excellent 1-to-2 or 1-to-3 risk-to-reward ratio, and you've got a mathematical edge that can literally transform a trading account over time.
We have covered a ton of ground in this explainer. We decoded the hidden mechanics of market liquidity, we found the exact footprints of smart money, and we walked through a tactical playbook to actually trade them. The institutions are out there right now, sweeping liquidity and leaving their footprints all over your charts. So the only question left is, are you ready to stop guessing and start following the footprints of the giants?